So if you're in CRE, maybe an executive, owner, operator, making those big decisions, you know how tough it is navigating maturing loans right now. It's a volatile market out there.
It really is. Feels like trying to chart a course in fog sometimes, doesn't it? Rates shifting, uncertainty. The stakes are definitely high.
Exactly. And that's why we're doing this deep dive. We want to, cut through some of that noise, maybe offer a clearer map, and pull out some really vital, actionable stuff to help you make smarter debt choices.
Yeah, get right to the practical insights.
Our mission today is pretty focused. We're digging into a real-world situation, a case study, actually, where trying to time the market, well, it had some pretty significant financial consequences.
Right, this isn't theory. It's what can actually happen.
A situation many of you listening might be facing or thinking about right now.
And what we're really going to unpack is this core problem. Why just waiting for interest rate cuts doesn't automatically mean you'll get lower borrowing costs. It sounds simple, but it's not. We'll look at the real financial hit when that kind of market timing goes wrong. And then importantly, talk about strategic actions you can actually take to line up your debt decisions with what you want to achieve with the property.
Protect that cash flow, right? Maximize the asset's potential.
Exactly.
And where's this insight coming from? Well, it's based on a real client interaction from last year. Insights shared by folks like Sean Murphy, who's Director of Deal Management, and Matthew Bailey, a Senior Capital Markets Analyst over at DeFeece with East 30 Capital.
Yeah, they shared a really telling client story. Really highlights these points well.
Okay, so let's get into it. Let's set the scene. We're talking about a mid-market owner. They've got a 120-unit multifamily property down in the Southeast.
Right. A tangible asset, real situation. This all unfolded less than a year ago.
And the details.
Okay, so this owner had an $11.5 million loan, 5.5% interest only. And the key thing, it was maturing in December of last year.
Crunch time approaching.
Exactly. So their big question, the one lots of people are wrestling with, was refinance early, get it done, or wait. And the waiting was based on this hope, this expectation, really, that rates were going to drop significantly.
They were hoping for cuts. How many were they thinking?
Well, the market sentiment back then, was pretty optimistic. Some are talking about maybe 4 rate cuts coming through that year.
Wow, 4. You can see why they might wait then. The dream, I guess, was lock in a much lower rate if they just held on a bit longer.
Precisely.
And this really taps into those basic goals of any refinance, doesn't it? You're trying to manage market risk, looking at fixed versus floating options, loan lengths.
Sure.
And crucially, making sure the debt fits the plan for the property itself. Like, are you holding it long term? Or is it a value add, quick flip kind of deal?
That alignment is absolutely key. Your debt strategy has got to support your business plan for that asset. Otherwise, yeah, you're just reacting.
Not driving. Okay, so what actually went down? Did they wait?
They did. They held out right until December. And here's the interesting part, the twist, maybe. Their expectation about cuts, it was actually right.
Oh, so the Fed did cut.
Yep. Cuts started in September. There was a pretty decent 50 basis point cut that's 0.5%. Then 2 more 25 basis point cuts before the year ended. So the Fed basically did what the market thought it would.
Okay, so far so good for the borrower strategy, it seems.
Well, here's the catch. Here's where it went sideways.
Uh-oh.
What they didn't see coming, or maybe didn't weigh heavily enough, was that while the Fed was cutting those short-term rates, the underlying market yields, things like 5, 7, and 10-year Treasury yields.
The ones that really drive fixed-rate CRE loans.
Exactly those.
Wow.
They actually increased, went up by about 100 basis points, roughly 1 full percentage point, at the same time the Fed was cutting.
Whoa, so cuts here, but rises over there.
Precisely. It's like pushing out on one end of a seesaw and the other end just pops right up. The cuts they waited for got completely canceled out, effectively negated by those rising yields.
So the delay didn't pay off, it actually backfired.
Completely backfired.
Yeah.
It just hammers home that thinking Fed cuts equal lower borrowing costs is way too simplistic, especially for longer-term financing. It applies across the curve, not just the overnight rate the Fed targets directly.
Okay, let's make this real. Forget basis points for a second. What did this mean in actual dollars for this owner, for their property?
Right, the bottom line. According to the info from Sean and Matthew, that owner's monthly payment jumped by about $10,000, just from the old interest-only period to the new one, because the underlying rate reset higher.
10 grand more a month, that's not pocket change, especially on a 120-unit property.
No, it's not. And it gets worse.
How so?
Well, once the loan matured and reset, amortization likely kicked in too, right? You start paying down principal. So when you factor that in, The total monthly payment difference, the actual cash leaving the account each month, swelled to more like an $18,000 increase.
$18,000 more per month.
Yeah, a really significant hike in their debt service.
So, okay, let's annualize that. 18,000 a month. Wait, no, the source of the annual increase was $118,000. How does that math work? Maybe the 10,000 interest-only jump was the main driver year over year.
Yeah, let's clarify that based on the source.
Yeah.
The initial shock was that 10K monthly jump, interest only to interest only. But over the year, considering the reset rate and potentially other factors like the start of amortization, the total annual debt service payment ended up being $118,000 higher than it would have been if they'd locked in earlier.
Okay, $118,000 higher annually. That's a huge hit to cash flow for a property this size. Even if the monthly numbers don't immediately sound like they'll break the bank for a bigger operator, that annual figure.
Ouch. It's substantial.
Yeah.
And it creates this domino effect, right? What happens when your cash flow takes a $118,000 hit like that?
Less money available, obviously.
Right. So first, maybe smaller distributions to your investors. Or maybe you can't hit the returns you promised them at all. That can damage relationships, make future fundraising harder.
Sure. Investor trust is crucial.
Then, think about value-add plans. Those unit renovations, the amenity upgrades, maybe fixing that leaky roof. Suddenly the money isn't there. Or it's much tighter. So deferred maintenance, delayed improvements.
Which hurts your ability to execute the business plan, potentially lowers the property value or slows appreciation.
Exactly. And just generally, less cash on hand means less cushion for surprises, less flexibility. It really impacts the financial health and the strategic options for that asset.
And just to be clear, when we say cash flow here, we're talking net operating income, basically, after paying the mortgage, but before paying out investors or funding big capital projects, right? That CFADS number.
That's generally the idea, yes.
Yeah.
Cash flow after debt service. That's the pot of money that gets squeezed first when debt service jumps unexpectedly.
Okay, pretty sobering picture. So let's shift gears. What are the lessons here? What can our listeners, these CRE pros, actually do to avoid this kind of situation?
Right, the strategic takeaways. This is key.
Lesson number one seems pretty clear from this. You absolutely have to model different outcomes. Don't just plan for the best case, right?
Absolutely critical. Don't just assume rates will fall and everything will be rosy. Remember, Fed cuts mostly hit short-term rates. They don't always pull down those longer-term treasury yields that underpin most fixed-rate CRE loans.
So you need to run scenarios like, what if the Fed cuts, but inflation stays high? Or some global event pushes yields up?
Exactly. Stress test your assumptions. See where your vulnerabilities are under different plausible market conditions, not just the one you hope for.
And what about floating rate debt? People still use that.
Good point. For floaters, remember you have tools. Hedges are available. Interest rate caps, collars, swaps. These can protect you from rising rates, give you some budget certainty.
And you mentioned something earlier, forward caps.
Yeah, forward interest rate caps. These let you lock in a cap rate for a future period based on where the market thinks rates might be heading. It's a way to sort of capture today's expectations for the future, potentially getting ahead of the curve. These aren't just for Wall Street. They're practical risk tools.
Okay, so model multiple paths, use hedges if you're floating. What's lesson two?
Lesson 2. Align your debt strategy with your actual property goals. This sounds basic, but it's amazing how often it gets overlooked.
Meaning match the loan type and term to how long you plan to hold the asset and what you're trying to do with it?
Precisely. Is it a quick value add deal? Maybe a shorter term floater with caps makes sense. Is it a long-term hold for stable cash flow? Then maybe a longer-term fixed rate is better, even if the rate seems a bit higher today. It's about matching the debt to the asset's life cycle and your business plan.
And that means looking beyond just rates, right? Considering the economy, consumer mood, what the Fed is saying.
Yes, keep an active pulse on the market. Understand the why behind the numbers. Your financing should be a tool supporting your strategy, not something separate you just react to.
Okay. Lesson 3.
Lesson 3 is maybe the simplest but hardest to follow sometimes. If the deal works today, just do it. Execute.
Don't get greedy trying to perfectly time the bottom of the market.
Exactly. Chasing that extra eighth of a point can backfire spectacularly, as this case shows. If the numbers pencil out now, if it meets your goals, aligns with investor expectations, pull the trigger. Conditions can change fast, and often not for the better. A good deal today is often worth more than a maybe perfect deal tomorrow that never materializes.
Sound advice. Which leads into lesson 4, I guess.
Yeah, lesson 4, actively manage your loan. This isn't the old days where you could just set it and forget it until maturity.
Things are too volatile now.
Way too volatile. Rates, yields, market sentiment changes constantly. You need to be reviewing your debt regularly, talking to your advisors, understanding your covenants, your exposure. Don't wait until 6 months before maturity to start thinking about it.
Continuous assessment, proactive planning.
That's the game now.
And lesson 5 seems like the big takeaway from the whole story.
Lesson 5 really sums it up. Rate cuts do not always guarantee lower borrowing costs. Period.
We saw it right here.
We saw it right here. Fed cuts don't hit all parts of the yield curve equally. They don't affect all loan types the same way. You need a strategy tailored to your specific situation, your asset, your plan, your risk tolerance. Don't just read the headlines about Fed cuts and assume your refi just got cheaper. Dig deeper.
Okay, 5 solid lessons there. Now, inevitably, people are thinking, the crystal ball question, will this happen again? This disconnect between Fed cuts and market yields. How many cuts are really coming?
The crystal ball. Everyone wants one.
Don't we all?
Look, the honest answer is nobody knows for sure. Anyone who tells you they do will be skeptical. But what we do know is that this dynamic, it's now a critical factor you have to consider in your planning.
It's part of the possible scenarios now.
Absolutely. We just saw it happen last year. When you run your numbers now, you have to ask, what if we get 2 cuts, but the 10-year Treasury stays flat or even goes up? What if we get no cuts? How does that impact my specific index? It's part of the risk assessment.
So, thinking beyond just the Fed funds rate, what else should CRE folks be watching closely that drives these longer-term rates?
Great question. It's a whole mix of things. Obviously, the Fed's target rate matters, but just as important, maybe more so for fixed rate, is that relationship between short-term rates and longer-term ones like the 10-year Treasury.
You mentioned the yield curve earlier, the inversion.
Right. We had that inverted curve for a while, short rates higher than long rates. That's unusual. Normally, you get paid more to lend for longer. So if the curve starts to normalize or uninvert, even if the Fed cuts short-term rates, the long end might stay high or rise as it gets back to a more typical shape.
So normalization could keep long rates elevated even with Fed cuts.
It's a real possibility. Plus, you've got inflation data, overall economic growth, global stuff, geopolitical risk. All these things feed into bond yields. It's complex. You can't just watch the Fed.
So wrapping this part up, sometimes it might actually pay to lock in a floating rate deal before expected cuts happen, if those cuts are already sort of priced in by the market?
Potentially, yes.
Yeah.
Especially with things like forward caps we discussed. It's about being strategic, understanding the probabilities, and sometimes acting before the widely expected event actually occurs. Being proactive, not reactive.
Okay, so let's quickly recap this deep dive, the big lesson from this real CRE story. Waiting for rate cuts can seriously backfire if underlying yields move against you. That $118,000 annual hit, ouch.
Definitely a costly lesson for that owner.
It really highlights the need to model different futures, align your debt with your actual property plan, and honestly, just execute when a deal makes sense today. Don't gamble on timing the market perfectly.
And agilely manage that debt. Keep your eye on the ball constantly.
So maybe a final thought for everyone listening, the CRE executives, the owners out there.
Yeah, here's something to really think about. Given everything we've discussed, the volatility, the unpredictable yields, how are you actively building flexibility and resilience into your debt structures right now? Are your current strategies really prepared for the unexpected twists the market might still have in store?
That's a really powerful question to take away. How resilient is your strategy? We hope this dive gives you some solid food for thought as you navigate things. Keep learning, keep adapting. Thanks for tuning in.